Well, hey everybody, welcome to the 912 Trader Trend review for the issue 1B, so the mid-January edition. We're going to be going over again the Trader Trend in its entirety and just kind of seeing how we did. So going along, the way we kind of start this off is we read through the expectations first, then we go through all of the Trader Trends. And again, this is a bi-weekly release and we cover the previous month's issue after the um, trades have kind of come to fruition, just to kind of check and also to clear up any questions or confusions about how to execute the actual playbook itself. So let's jump on into it. So here we go for market expectations for mid-January. Like we said in the last issue, honestly, the beginning of the year is a crapshoot and has definitely proven to be so. And yet we are still within the same 3,500 to 4,100 range we've been in for the last 4 months, continuing the frustration of anyone following the intermediate and short-term trends, and rewarding handsomely those who simply took our advice of going for the investor trend suggestions where the suggestion is neutral. The strikes of the short puts are far enough out of the money to give you either a great accumulation level or money in your pocket. And continue grabbing those featured investor suggestions for the same reason. Get great accumulation level or it runs to target for minimal cost. And frankly, we don't see any reason to change course in that outlook, except maybe adding into the mix the trader trend naked put suggestions if you're adventurous. We are still in the range, and the major indexes have not convincingly moved into an intermediate uptrend. They technically are, but don't be surprised if you get stopped in retracement of Friday's move. For the bear case, inflation is still very high, period. Earnings are down, tech is laying off a lot of people, home prices are falling, food prices are rising, and the brief relief we saw in energy prices is just that, brief. For the bull case, everything that is bearish, layoffs, falling housing prices, ISM under 50, poor earnings, exactly what the Fed wanted. And the Fed could be ready to sit back and let previous rate hikes work through the economy. Possibly only a 25 basis point hike at the next meeting, using current market rationality. A 25 basis point hike is basically a signal of a 25 basis point cut 6 months from now. February 1st will be an interesting day. As for commodities, there's no reason to believe that their uptrend is going to end anytime soon. The days of king dollar are behind us. The days of 75 basis point rate hikes are a thing of the past. Commodities are an exception to the advice of being cautious. Trader trend suggestions are fine. Same for oil-related vehicles. The war in Ukraine isn't close to ending, and even if it did, Russian oil may still be a problem. As for bonds, we don't see a lot of upside. The bottom definitely looks to be in place. There's another area where, although they are technically in an intermediate uptrend, they just aren't to be trusted. Stay wide with investor trend suggestions. And that's about it. That's life in the range. So stay wide and relax. You know as well as I that there will be plenty to worry about soon enough. Government shutdown is anyone? So remember the way this works, you guys. The results will always kind of vary based on your decision to take you to the trader trend or investor trend suggestions. Um, and although the write-up definitely, obviously is suggested investor trend, mechanically you could go into the trader trend too. Just really depends on your risk tolerance and what you want to do. And so, we're going to go through this and we're going to cover the trader trend and see how it actually did. Um, because all these things, obviously, the strikes all were, February strikes. So the first one was Meta. And you can see right there that the trader trend um, was bullish, and the trade was to sell the 110 naked put, February naked put, um, with a stop at 108.38. Now, if you had got in, you would have got in right away at 108 when stock was sitting at about 139.29. You would have got out with full profit on that, probably bid back those units for 5 cents, making $103. So that was a winner right there. Moving on to bonds, the trader trend uh, for HYG was bullish, and it was to, again, if you read in the write up, selling the just, remember the way this works, guys, when you get something like this, is that really, you only kind of, if you want to play this, only have to sell the naked put. If you're hyper bullish, you do the vertical. But we covered both and kind of just looking over it to see, what happened here. Now, if you had sold the 75.50 February naked put, you would have got 65 cents for it. And because price opened at 76.10, which, obviously entry for the vertical was 75.80, so you were relatively, close to getting filled with the stops at 75.04 and the target at 78.08. So you would have got 65 cents on that, and actually would have got stopped out on February 10th, but you only would have lost $1, uh, because Theta worked for you on that one, and you would have got filled on the vert, and that one would have got stopped out for 51 cents because bots just fell down and hit that stop loss there. So a pretty small stop on that, um, or pretty small loss on that guy in its entirety too. But again, listening to the write up, selling the put, you would have lost $1. Um, but if you had done a bull put spread, you would have lost 51 on that one. All right, so going on to TLT. TLT, the play was to most to sell the 107 naked put and then get into the bull put spread if you were hyper bullish below 107.35 with a stop at 105.10. Now, the stock opened at 105.57, which we've talked about before is very, very close to the stop. So, not recommended to take the vertical with that close of a stop. You'd want to wait, see if it actually traded below the stop, let it retrace back through 107 before putting on that vertical, or just don't do anything and just really wait. Now, if you had got in right away, the mechanical entry was at you would have got a $2.27 premium on the 107 naked put, um, and it got stopped out right away for $13 loss. And the vertical, obviously, if you had filled it, you would have got stopped out real quick for an $80 loss there too. So again, this is one that probably could have easily been avoided because it opened so close to the actual stop. Going to LQD, the suggestion here was to sell the 109 naked put, and then if price traded below 109.58 to enter the 109.114 bull put spread with stops at 107.88 for the entire position and a conditional target on the bull put spread of 114.67. Again, price opened on this one at 110.15, so you weren't really, you were above the entry. So if you had taken the naked put, you would have got it for 85 cents, and that one actually stopped out on February 10th for 57 cent loss, $57 loss, and then the vertical filled on that day, that same day, if you had played it, and you would have had $105 loss on that too, as bonds fell pretty hard on February 10th. Going on, EFA. So EFA, the recommendation here was to on the trader trend was to sell the 68 naked put, and then if price dropped below 67.94 to hit the 68.75 bull call spread. Stops for the whole position at 65.57 and target at 75.05. That one you would have got 68 naked put for 40 cents, and you would have got that back for a nickel, netting you $35 per contract. The actual now when price opened on this, it actually opened at 70.70, and so um, going through the price never actually traded down to get a fill here, so there was no entry on that. Going to EWW. EWW, the recommendation was to sell the 53 naked put, and if price dropped below 53.37 to enter the 53.59 bull call spread with a target of 59.24 and a stop at 51.24. If you had sold the 53 naked put, price opened at 57.09. You would have got a quarter for it, so 25 cents. You would have bid those back for a nickel and made $20 per contract. There was also no entry on the actual vertical here. It just never came down to that price. EWZ, if you were again, if you look at this one, right, uh, if you're aggressive, you're selling that call, selling the 30 call at 29.81 for a stop. Conservative traders just maintain cash. You don't do anything. Now, if you had have actually sold that call, price opened at 29.16, so you would have got 80 cents or 79 cents for the 30 call, and you would have got stopped out on Jan 24 for a $17 loss, because it just took a while to get there. Um, so moving forward on the metals, commodities. So we got gold. Gold was the recommendation was to sell the 171 naked put, and then if price dropped below 171.22, then you put on the 171, 181 bull call spread with a target at 181.30 and a stop at 167.17. Price opened at 178.35 here, so you would have got the 171 for 57 cents, which then got bid back for a nickel, and you made $52 per contract. Uh, on this one, there was price came down to that fill on the 15th of February, and since it was 2 days before um, expiration, there you took a $51 loss, um, or you were long 100 at a 170, 177 cost basis there, and so that one it was just so close to the expiration by the time that this conditional entry actually got filled. So going on to silver. Silver, the recommendation here was to sell the 21 naked put, and then if price dropped below 21.38, then you put on the 21.24 bull call spread with a target at 24.24 and a stop at 20.43. So price opened at 21.18. You could have sold the put for 55 cents, and on the 6th of February, that would have got stopped out for $19. Uh, Also on this one too, the bull call spread um, would have filled on February 6th, but you actually probably wouldn't have filled it because the 24 wasn't sold. It was under 15 cents. So that one would have been a small loss, $55. But the actual, like I said, the actual short unit wasn't actually sold on that one. So moving forward and to XME, XME, the recommendation was to sell the 49 naked put, and then if price dropped to 49.88 or below, was to buy the 49.58 bull call spread with a target of 58.46 and a stop at 47.02. Price opened at 56, and sorry about that. Price opened at uh, 56, and you would have got 90 cents um, for that 49, yeah, for that 49 unit there. And on that one, price actually, you actually got that back for 5 cents, so you would have made $85 on that one. Now the vertical, there was no entry, so price actually never came down um, to the 53.08 price point here. Actually, I was looking at the investor trend. I'm sorry about that. So the trader trend was the 53 naked put with the 53.58 bull call spread. Sorry, a phone call came in. It took my eyes away from the screen. And so, yeah, and the vertical never actually got filled on XME. So moving forward into XOP. So XOP, the trader trend suggestion was to sell the 145 naked put, and if price dropped below 145.05, to put on the 145.160 bull call spread with a target at 160.53 and a stop 139.89. Uh, Now this one price opened at 143.09, right? Which was, it was definitely below the entry, not too far from the stop. For the 145 put, you would have got 625 credit on that. Um, and you would have got stopped out on January 25th for a $160 loss, uh, kind of minimized, obviously from the, from theta decay there. And then if you had taken the vertical, that would have got filled on Jan 23rd, and you would have taken a $130 loss on that one. Okay. So moving forward to XLE. XLE, the recommendation was to sell the 89 naked put, uh, and then if price dropped to 88.94 or below, was to put on the 89.98 bull call spread with a target at 98.41 and a stop at 85.78. Now, price opened at 91. 14, and you would have got 165 for the 89 put. And that one you would have got stopped on February 2nd for $220 loss. And the spread filled on January 24th, and you would have got stopped out on that as well for $237 loss if we had taken the been hyper bullish on this position. Going forward onto DVA. DVA again is one of the ones where if you were very aggressive, you would have sold the call the February 20 with a stop at 1996. Conservative traders would have just done nothing, stayed in cash. When the market opened, it was 1943 was what this was trading at. You would have got 15 cents on the fill for DVA, and that one actually got stopped out on January 30th for the 15 for the full credit, so you would have $15 loss on that. So moving forward onto XBI, the biotech. XBI, the recommendation was to sell the 84 put, and then if price dropped to 84.63 or below, was to buy the 84.89 bull call spread with a target at 89.49 and a stop at 83.01. Uh, Price opened at 87.02, and you would have got 176 as the credit for the naked put with that stop at 83.01. That one you would have got back for a nickel, netting you $171 per contract there. And the bull call spread filled on February 13th, and you would have been up $124 at the uh, on February 17th there, or long 100 shares at 85.56 cost basis. So moving forward to VNQ. VNQ, the recommendation here was to sell the 88 naked put, and if price dropped to 88.81 or below, to put on the 88.95 bull call spread with a target of 95.58 and a stop at 86.55. And so this one, the 88 filled at $2.05. Price opened at 87.70, which was definitely below the conditional entry. And you got that whole thing back. So you got 205 for those 88s, and you would have made $200 if you had have bid those back for a nickel. Now, if you had have actually filled uh, the bull call spread itself, that would have got filled, and you would have got those that bull call spread for 181. The 95 unit actually sold at 15 cents on January 24th. In the 88, you could have bought it, or that's what it actually was selling for 15 cents. In the 88, you were buying it for 196. So again, getting it for 181. At the end, in February 17th on expiration, you would either taken a $34 loss or been long 100 shares at 89.51 cost basis if you wanted to turn that into stock and keep it going. So moving forward to XHB. XHB, the recommendation was to sell the 63 naked put, and if price dropped below 63.33, then you would have put on the 63.68 full call spread with a target of 60.54 and a stop at 61.59. XHB opened at 65.16. You would have got a $1 credit for the naked put. You would have got the entire thing back for $95, bidding it back for a nickel. And if you had taken or been bid to take the full call spread, there was no entry, so definitely didn't get filled on that one. Going on SPY. SPY, the recommendation was to sell the 398 naked put, and then if price went to 398.69 or below, to put on the 398 421 bull call spread with a target of 421.08 and a stop at 391.23. So if you had got this filled, you got it filled. Price opened at 369.72. That got filled for $7.93. You got back the entire premium for a $788 per contract trade on that. The bull call spread itself got filled on January 23rd, and for about $211. I'm sorry, it got filled for 715 per contract, and then at expiration you would have been able to close it for $211 or been long 100 shares at 405.15 on the cost basis. So going on to the Qs, the recommendation here was to sell the 287 put, and then if price dropped below 287.72 to buy the 287 304 bull call spread with a target of 304.52 and a stop at 282.16. Price opened at 283.54, so definitely opened within the area to put on the bull call spread. You would have gotten a $8.63 credit for the naked put, which you would have got back the entire thing for a nickel, making $858 per contract. Uh, the bull call spread got filled that same day, and for $5.10 per contract. And at the end, you were up $906 or long 100 shares at 392 cost basis on that one. And so moving forward to IWM, and I'm sorry, that was a 292 cost basis. My mistake. Uh, so on the Russell for the trader trend, the recommendation was to sell the 184 naked put, and if price dropped to 184.23 or below, to put on the 184 195 bull call spread with a conditional target at 195.32 and stop for the whole position at 180.60. Price opened at 185.43, and you would have got $3.86 for that whole position, which you would have got the whole thing back for $381 profit when you bid it back for a nickel. And the bull call spread was filled at $4.15 on January 25th, which at expiration that was a $498 in profit, or long 100 shares at a 188.15 cost basis on that one. So overall, if you had have just sold the puts on all of these, that was a $2,286 winning issue just for the naked puts on everything. If you had just done one uh, contract for each of the recos. Now, if you had have went and done all of the verticals too, that was an additional $996 of profit there, and potentially been long the stock too at these positions with the cost basis, or just closed them out at expiration there. So that is it, you guys. Remember, we're going to keep up on these. Still going through, making sure mechanically we understand the long game that trading is, and the mechanical advantage and the professional risk management that the playbook provides. Thanks, everybody. We'll see you next time.